Okay, I'm back with the second portion of the balance sheet. Again, my name is Zach. I'm with Group 3, and I'm just going to complete the balance sheet with the liabilities and equity section. Again, our company is Uberpong, and it's a small company that basically screen prints on ping pong paddles and then sells them to various clients around the world. One thing that I didn't mention in the last video is that, interestingly enough, a lot of the sales for the company actually come from other countries, like especially China. And a lot of the data that we had, or that we obtained, came from the actual website of the company. It's been really interesting to research that company. So liabilities and equity section starts with current liabilities. And that's going to be the accounts payable section, which is going to be, basically it's going to be our assumption for days of accounts payable, and then the cost of goods sold divided by the cost of goods sold times 365 for the number of days in the year. And that gives us the total accounts payable account. The income taxes payable is the next line item there. And that is basically just the income tax expense, but it's accumulated. So, well, it's not accumulated, but it increases with the actual net income or income tax expense. And the income tax expense, just to illustrate where that information comes from, you have to go up to the income statement, and that comes from the actual taxable income times our rate, which is, we figured 34%. We got on, there's no state income tax in Texas based on our research for our assumptions. So it's just the federal income tax, which seems to have an average rate of about 34%. So that seemed realistic. I know we had to jump into the income statement for that, but that shows where that calculation comes from. So that's income tax payable account. Then this is just a total line for those, for the current liabilities. And then down to the mortgage loan. The mortgage loan is amortized on the second tab, just like in the original example. And our mortgage started at $346,000 because of we have a down payment, and then when it's done at the end of the 10-year period, there's still $284,000 left. And as you can see, that corresponds with what we actually have in the mortgage account, the mortgage loan account, starting at 341 and ending at 283,541. We have no extra bank loan. And then this line is just for the total liabilities. So it's just a total of the liabilities reported on the account. Our common stock begins just as a percent of sales, and then after that, it's just an addition. Retained earnings, that formula is a little bit goofy on here because it's the cell to the left, but retained earnings is the net income, and then it's accumulated. That account is accumulated across the whole thing. So as you can see, the retained earnings increases substantially. And then this is just a total line, and then for the total liabilities and stockholders' equity. So that's total liabilities plus the total equity. And then the last line is the DFN, which those were not zero. So obviously we had to take those numbers and put them in extra cash. So then the numbers that were here moved to extra cash, and it zeroed out the difference so that the total assets and liabilities and stockholders' equity would match. So the general accounting formula would balance, and the balance sheet is balanced. So that is our balance sheet, liabilities, and equity section. Thanks for watching.